All right. Good morning, everybody. Welcome to the new year. U.S. manufacturing PMI. This has the potential to rock the market a little bit. So definitely watch the clock today. It's the mantra. I say it all the time. I'll continue to say it all the time. Watch the clock. Did you see that really beautiful, absolutely amazing reversal Friday right at 3 o'clock as we got into power hour? Things close at different times. The dollar and the bonds close. And actually Friday, the bonds had closed early, but either way, markets close at different times. Different economic events come out throughout the day. The ones that we're looking at here, these are just what they would call headline events. But there are a lot of events that don't hit the news. They're just not seen as exciting or relevant, and they just don't filter through into the bigger cycles. But these are not all of the economic events on the docket today. And if you notice, when you start going to different places, they don't always match, right? So here on Market Watch, we've got 9:45 and 10 a.m. S&P U.S. manufacturing PMI for December. We are below the 50% level. Previous was at 46.2. And then construction spending at 10 a.m. That one's not anticipated to be as explosive, but this is a highly data-driven market at the moment, and it's worth watching the clock, right? Watch the clock. Watch the clock. All right, this is a weekly chart of the S&P. I'm going to zoom in just a little bit. We can focus on what is really important at the moment. These 3 weekly candles with a range from 39.20 down to 37.90. This is everything right now. This is the range that we've been in for a while. It's the range that we need to get out of. So we can have these short bursts, explosive moves that just drive us to one edge of the range or to the other. But we need out of this box. The moves are compressing, even though we did kind of wick out there above 3,900 last week. We're still getting these higher lows. Everything is compressing. We're winding up more and more and more energy, looking for a move out of this box. So don't get shook up. If you're looking for some swing trades, the idea would be that there's a bias behind your swing, right? We're going to go long for 6 to 8 weeks, or we're going to go short for 6 to 8 weeks. Until we get out of this box, you don't have a trigger for a bias, right? We spent 3 weeks going sideways. So you can have a bias that says, I think we're going to go up. Yeah, maybe. You want to put your money on something that doesn't yet have a signal? It's your money. Volume coming in a little heavy this morning compared to what we have seen recently, but still not enough to trigger any kind of concern. It should just kind of stand out a little bit. All through the holiday weeks, the volume was really light, right? And that makes perfect sense. It wasn't really that much of a surprise. It wasn't concerning. But what our normal is usually somewhere above 120 and less than 200. And hey, we're in that range, but we're on the upper edge of that range. So we are showing a little bit of a heavy volume this morning. Still not enough to be concerned, especially when we know that the econ coming out of Europe very likely had a little bit to do with that, right? So if there wasn't anything on finance juice, or if there wasn't anything when we looked around, then maybe this level of volume would give us some concern, but it's below 200 and we did just get some econ. So very likely that's the reason for the season. Oh, for goodness sakes, highlight the darn thing. Ha, we don't need it. We get rid of it. All right, we opened gapped up last night. Classic. Opened up and then immediately ran down to close the gap. Overshot that. Came back up and overshot the open from last night. Rounded over again, and now we're just sitting in the range. We are inside day breakout. If you're focused only on the RTH, well, I guess even if you're not focused on the RTH, right? We are still inside day breakout at the moment. It's what we bounced off of in this move to the downside, the structure from yesterday. Yesterday being Friday. It's my bad English. So the focus right now is it needs to keep this. I'm gonna have to fix that for a while. Notice that this green candle is a solid green candle, where normally these candles are hollow. It's solid green because we opened, gapped up way up here, and we have fallen down to this level, but we're still higher than where we closed on Friday. So because we're higher than where we closed Friday, the candle is still green, but it's a solid green because we're lower than where we opened. At the moment, we're outside of this really big green candle from last week. While I've got those range control lines on based on the weekly, the box that I just drew would be your range control lines on a daily. So one step at a time. We got to get out of the box, keep it, and then start hitting each pivot point on the way out. Until then, we're just still stuck in the middle of all of this. We're above the daily pivot. We're above the weekly pivot. We've already hit the daily, so it's not an MDP. And right now, because of that move that we had earlier in the Globex, that's going to be your most important level to resolve right now. So 3906-ish, Globex high. I point this out because remember, these days, they just repeat over and over again. One of the things that we've seen is where the market in the pre-market sets, a reasonably decent high, and then sells off from it. Then when we get into the cash open, it makes a run, tests that high, fails, and dumps. Now it overshot it just enough to suck in all the bulls, get everybody convinced that we were absolutely going to get a breakout, and then it dumped it on their head, got a squeeze there, and their selling helped facilitate the move. And we had that fake breakout fast failure play, right? It's exactly the kind of setup that we're primed for today. Now, I don't know it's going to do that, right? We don't know if it's going to go up, or if it's going to go down, or if it's going to struggle at that level. The point is, we now have the setup for it. So we got to be aware of it, got to be prepared for it, so that if we make a run for it, don't just automatically assume everything's turning bullish and you try to go long on it. We've got to get it through that level and close above it to have a solid play. And you can trade up to it, right? There's no reason to wait, depending on, if you're scalping or day trading, whatever. Just watch that level. The one down here, the Globex low, 38.42. It's below the pivots. It's more than a half an ADR away, which is fine. This indicator isn't exactly perfect when it comes to where the ADR is being recorded. It's using where we gapped up and opened, not where we closed on Friday. And, it's not too bad. A little bit of a gap. But if you were to look at this ADR of 2% and measure a 1% move on your own, say from 4 o'clock, that would be 1.025. That puts us down at 38.27, not 38.55. All right. So, just some reworked ADR levels. This is why understanding the tool that you're using helps, because when it doesn't do what it's supposed to do, you can at least recognize it's not doing what it's supposed to do. All right, so some different ADRs. All right, like we talked about on Friday, the range is much more narrow now. We lost a lot of that volume and price action off the backside. We've got a classic D shape. Ran into some volume at that 39.11, which is a cog line. Ran into some volume around that, couldn't make it through. That level of resistance held. And the point of control will very much act like a gravity. So now that we've headed back down, it wouldn't surprise me at all if we actually make it all the way back to that 38.60. When we're at the top of the box, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. In the next 4 or 5 hours, we're going to lose what's outside of this box right now. And it's going to narrow things up just a little bit more. This is everything that we're focused on. And there's only two areas of really concern, 38.60 and 39.11, which is that cog line. And it should already be on your radar. Now, an argument could be made that the untouched point of control from Friday could be carried forward. Some analysts argue that anything in the pre-market with a pivot touch like this wouldn't necessarily count, right? That they would want to see it in the regular trading session. It's not about what's right or wrong. I can point you to a lot of books and research that says do it one way, and a lot of books and research that say do it another way. It's really just user preference. The point of control was barely hit, right? But if you're going with an untouched point of control, well, you can't say it's untouched anymore. It has been touched, right? So it's no longer a VPOC. But we didn't close through it, right? We didn't get a solid commanding close on the other side of it. And the reason that pivot points are so easy to focus on is because it's all about liquidity. If we consider the idea that liquidity is on the other side, we didn't get into it, so that liquidity is still there. You, from that point of view, could mark that and carry it forward as the point of control, not as a virgin point of control, a VPOC, because, well, it's been touched, but still as a significant level that needs to be carried forward because we haven't resolved that level yet. And that wouldn't matter if it was pre-market or regular trading hours. We didn't go through it and get into the liquidity on the other side of it. So worth carrying forward, but I wouldn't call it a VPOC at this point. The market makers are pricing in more volatility. You can see that the range this week for the weekly expected move is bigger than the range from last week. It's an easy visual. Just draw a box on last week, grab that box, bring it into this week, and notice that it doesn't fill the whole range. So they added some more volatility. Now, it doesn't look like much volatility, but I want to point out that that's a 4-day range, right? Just like last week was a 4-day range. So we can't look at that and say, well, it's a bigger range because it's there's more days. Nope. Last week was 4 days. This week was 4 days, and yet the range is bigger. So they're pricing in more volatility. There's an expectation that the market can make a bigger move, and it wouldn't even be an outlier. We're barely below the 10-week, about 0.5%. So, from this analogy, we're basically still standing in the center of the basketball court, and we could make a run to either side. We're not overbought. We're not oversold. On the 10-week, we are just slightly below it. So the market is fighting with it right now, interacting and trying to resolve that 10-day moving average. We're right at the center of the basketball court. Could make a move either way. We're not overbought. We're not oversold. We had been below it, as you can see. We expanded reasonably well, nearly 2 3/4% away from the 10, and then rallied back into it. Now, if you think about the way that a market moves in its trend, right? We get that pullback, and then it continues to the downside, and we get a pullback, and we continue to the downside. And if you're having a market that's following with its 10-period moving average, then it makes sense that we come up and we tag that 10 before continuing on to the downside. So right now we just need to resolve it. Are we just tagging it before making the move lower, or are we actually going to break through it and resolve above it? Got a pretty decent reversal in PayPal this morning, 2.5%. NVIDIA nearly 1.5%. NVIDIA is already gapped up outside of these two green candles. We're sitting at very close to 148, 148.5. So it's sitting all the way up there this morning. And Google's up more than 1%. 89.20 puts us outside of the top of this candle here too. So still inside the range. Google would have to get above 89.50. All right, so we got the same setup on basically all of these. See which one's got the cleaner. Yeah, we'll use Amazon. All right, so every one of them had that gap up. And then every one of them's got that liquidation that came in at 6:30. Now it's trying to resolve, and we're stuck within that range. Facebook, Netflix, Intel, Meta, they've all got this setup right here. I think Meta's got a pretty clean example right there. Notice it's like a gap close, right? From Friday after hours. It opens, tries to, this is all algo, shoots to the upside, then resolves itself, closes the gap. And now we've got this little micro range. Just like we were talking about with the ES, that Globex high is now your focus to the upside. If you're thinking that this bullish move is going to stick and we open, within this zone, try to avoid the fake breakout by letting it get above that Globex high first. Now, obviously, if we open really sold off back towards the open of yesterday, and then we're making a run for it, well, there's plenty of room. It's a good $4 move. There would be no reason to wait. You could just run it back up again. But talking about opening anywhere near between, say, where we closed on Friday and that Globex high print from this morning, if we open up inside that area, you're going to want to see it get through that zone first before you try to run long on this thing. And just keep in mind that that big green candle that we're seeing on all of these, it's all algo driven, right? It's like the basket of stocks had to be bought because of X, right? Whatever that X happens to be. If A, then, right? If A, then B. There's really nothing negative showing, just because of the way that these scans and watch lists and everything, it's because of the way that they function, right? Since that gap up exists in all of these names, even though we've sold off from that, it still shows that everything is either flat or positive, because we haven't at least got back to where we were on Friday, right? We haven't gap closed and gone below that. So it looks really good out there if we're only looking at the watch list. But looking at that pattern, that didn't really inspire a whole lot of confidence. All right, so watch the clock this morning. I can't stress it enough. This is a market waiting for a reason. We've been range bound now for weeks. It can't last. It's one of the few promises the market can give is it won't stay here. Be careful on the market is still under the impression that the Fed is going to in some way pivot this year. Even though the Fed has said no pivots coming in 2023. So, at some point when the market realizes the Fed has not been lying to them, they said it was going to be higher for longer, and they're still saying it's going to be higher for longer, and they still don't have a solid upside target on their rate hikes. All right, we're looking at KWEB. This is our China Internet ETF. Kind of use this for a gauge of risk on, risk off over in Asia, which generally can drive like a short covering rally or, kind of fuel these alternative tech names. I think the range in that is more clean than the range in other things, but still range. So it's up this morning, got a nice little run to it, but it needs to get out of the box. Now I want to point this out because it's part of the control that we use all the time. This move that we saw in the dollar this morning was accompanied by this move we saw in the S&P this morning. That was the dollar and the futures moving in the same direction at a significant speed and rate of change. Right? So that whole idea of, oh, the dollar is going down, the S&P is going to go up, that's not as solid as it was 2 months ago, right? That used to be a sure thing. You could lean on it. But nothing lasts forever, including that inverse relationship between the dollar and the futures. So this morning, anyways, that's off the table. Notice as well, the S&P sold off, took the whole move back again, but the dollar didn't. The only thing the dollar quit doing was going up. It didn't give it all back. It just held where it made the move and stopped. That's a little wonky. The main takeaway from that is we can't look at the dollar and use that for any signal that the S&P is going to go up or that the S&P is going to go down. What we can use it for is if the dollar starts making a big move, look for a big directional shift in the S&P and the NASDAQ. Don't automatically assume it's going to go in the other direction. Just get ready for a big move because we've seen a big move in the dollar. We've seen a big move in the futures. That much stuck. The only thing different now than it was, say, 2 months ago is instead of going in the opposite direction, both of them went in the same direction. We need these to decouple if we're going to see that inverse relationship again. And maybe it already has decoupled this morning since the S&P sold back off and the dollar didn't. We don't know yet. We got to watch for another big move in the dollar, right? Which kind of brings me to my point. Watch for a big move in the dollar. All right, we're looking at the VIX futures since the VIX has that gap up that isn't really functioning correctly this morning. And looking at this, the VIX is down. It's not up as it is looking at the VIX, the VIX, right? All right, continue to keep your eye on US dollar Japan. We've got a monthly level at 131.24. Right now, it's acting as a pretty significant level of resistance. It's very likely going to continue to help with that dollar staying down. right? So seeing the dollar kind of hold below that 105 level, it's the focus that we want to keep. And for Tesla, so there had been some questions last week on, hey, is it time to buy yet? After a market moves that far, you kind of get the impression that it's oversold and that it's due for a bounce. And it started to find a little bit of support last week, right? And tried to rally a little bit to the upside. Keep in mind, this thing is done, right? Like it doesn't have that golden boy halo to it anymore. So you can't just assume that it's going to catch bid and rally back up and recover from these lows. Getting a relief rally or, a dead cat bounce or some move to the upside before it rolls over and continues going lower, sure, that's definitely on the table. We got a gap to close at, call it 137.75. The gap from 123 is done. We've hit it. That's it. So that one's done. And there is a gap below us at 113, right? 112.80. Target on this for 2023 is that we'll at least get another 50% cut off of it. So, we're looking at around $55 to $60. But it's not going to be a straight shot, and most of the short, easy money has already been made. Right. So if you're looking for a continuation in this, you want to continue to run it short, wait for a good up move first, right? So that you're not shorting in the hole. And to flip it over so we could kind of have an upside place to discuss, it would be this spot right here. We're looking for that upside move, right? Before rolling over and continuing to the downside. We are primed here for a TRB, trendline breakover. But even then, we're more than likely going to base. And I doubt we're going to get a real bear flag failure. If it was going to be a bear flag failure, then we would base down here and we would reciprocate, which ends up making one really big cup, and then the handle, and then the rally. But that's for a good market and a good recovery, and that's not this, right? So watch for any break to the upside to resolve the gap right around that 137 area. We're still just looking for that move up, that dead cat bounce before going lower. 234 in Microsoft needs to be broken if you want to join the short. Otherwise, we're looking for this to roll over. Catching a new entry off of the same thing that we were just talking about in Tesla. You got to get that drop to the downside, a rally up, and then a continuation to the downside, right? So right now, we had that little bit of a rally up, still needed to roll over. So catching it on the highs for a flip, or catching it on the breakout, not getting in somewhere in the middle, right? Don't diddle in the middle. Same thing, Apple's got a TRB setting up, building a really solid base inside of this massive candle. We are IX10 inside of that, but it doesn't matter because the candle's just so big. A break above 131 runs us back to 137, 138 area. We're still looking for this rebound, move lower. We'll know we're wrong on that short if it gets above, say, 137 and closes above that. Because if we're still bearish and still short, it shouldn't be up here. Netflix is on Seeking Alpha's list for contrarian trades. A suggestion that while the entire tech space and marketplace is still bearish, this is not. And if you wanted to run a contrarian play, kind of buck the system and buck the analysts, then a long in Netflix is the way to go. Now, speaking of analysts, they're still on the hot seat. They have not revised a lot of their projections and revisions on some big names: Tesla, Apple, Microsoft, Google, the FANGs. And the discord out there, the discourse, right? The communications in space where Bloomberg and others are poking fun of them, chipping teeth, talking smack. The analysts aren't doing their job. Look for that to change in the next 2 weeks. A lot of heavyweight revisions coming out with not just a price change, but with actually some data behind it. That they come out with a report saying this is why we're giving it a price change and what the new levels are going to be. I think that will significantly reprice equities when we see that. Hey, everybody. Welcome to the new year. Have a good day, and I will see you all tomorrow.